Today, we're diving into a crucial topic for any business: budgeting and forecasting. These are fundamental for financial health. They help us make informed financial decisions, ensuring our future success and guiding strategic planning effectively. Let's explore the core concepts of game theory, a fascinating field that analyzes strategic interactions. This helps us understand strategic interactions in business, anticipating moves and optimizing our own decisions. First, we have players, who are the decision-makers involved in any given game scenario. These players can be firms, consumers, or even governments, each with their own objectives and choices. Next, we consider strategies, which are the various actions available to each player. These are the possible courses of action that each participant can choose to undertake. Then there are payoffs, representing the outcomes or returns for each player. Payoffs are essentially the results or rewards each player receives based on their chosen strategies. Finally, we look at equilibrium, a stable state where no one wants to change. It's a stable state where no player can improve their outcome by unilaterally changing their strategy. Now, let's explore the different types of games we encounter in business strategy. We'll see how players interact and how the final outcomes are ultimately determined in various scenarios. First, we have cooperative games, where players work together towards a common goal. In these games, players often form coalitions to achieve mutually beneficial results and agreements. They can make binding agreements, which means they are committed to their collaborative strategies. In contrast, non-cooperative games involve players acting independently without formal agreements. Here, each player acts purely in their own self-interest, without explicit collaboration. There is no formal collaboration or binding agreements between the competing players. Next, consider zero-sum games, where one player's gain is exactly another's loss. This means that if one player wins, another player must lose an equivalent amount. The total sum of all winnings and losses across all players always equals zero. Finally, we have non-zero-sum games, where gains don't necessarily mean losses for others. In these scenarios, players can both win or both lose. Outcomes are not strictly competitive. Indeed, most real-world business scenarios fall into this category, allowing for mutual benefits. Let's dive deeper into a fundamental concept: the Nash equilibrium, a cornerstone of game theory. The Nash equilibrium is where each player's strategy is optimal, given others' choices. No player benefits by unilaterally changing their strategy. Now, let's look at different types of strategic interactions in the business world. It's crucial to understand how the timing and repetition of decisions impact outcomes. First, we have simultaneous games, where players make their decisions at the same time. In these games, players act simultaneously, without knowing the choices of their opponents. Next are sequential games, where players make decisions one after another in order. Later players can observe the actions of those who moved before them, influencing their choices. Finally, we have repeated games, which occur multiple times over a period. These repeated interactions allow for strategy development and foster potential cooperation between players over time. Let's explore some common pricing strategies that businesses use to set their product prices. These are the key methods businesses employ to determine how much to charge for their goods. First, there's cost-based pricing, a straightforward approach to setting prices. Here, the price is simply calculated by adding a markup to the product's total cost. This method is very simple and easy to calculate, making it popular for many. Next, we have value-based pricing, focusing on the customer's perceived worth. Prices are set based on how much value customers believe they are receiving from the product. This approach can often lead to higher profit margins, as it aligns with customer benefits. Then, there's competition-based pricing, where rivals' prices guide your strategy. Here, prices are set by comparing them to what competitors are charging in the market. This helps maintain market competitiveness and ensures your offerings are attractive to customers. Finally, we discuss penetration pricing, a strategy for rapid market entry. It involves setting a very low initial price to quickly enter a new market. The goal is to quickly gain a significant share of the market by attracting many customers. Let's delve into strategic pricing exploring the critical considerations that shape how businesses set their product prices. We will examine the various factors that influence and ultimately shape effective and profitable pricing decisions for any business. First, we need to understand the market dynamics, which play a crucial role in determining how we approach pricing our products. Consider market demand elasticity. How much does demand change when you adjust your prices? This is key. Next, a thorough competitor pricing analysis is essential to understand your rivals' strategies and position yourself effectively. Also, don't forget the regulatory environment, as various rules and laws can significantly impact your pricing flexibility. Now, let's turn our attention to the internal business factors that directly influence your strategic pricing choices. Your internal cost structure, including production and operational expenses, forms the foundation for setting profitable prices. Your brand positioning and image also heavily influence pricing, as premium brands can often command higher prices. Finally, your profit maximization goals directly guide pricing strategies, ensuring that you achieve desired financial outcomes. Today, we're focusing on investment decisions, also known as capital budgeting, a critical aspect of financial strategy. These decisions choose projects adding long-term value, requiring significant capital, and having lasting implications for the company's financial health. Let's explore the key elements that form the foundation of sound investment decisions for any business. We'll identify the core factors and principles that guide how companies effectively allocate their precious capital resources. Capital budgeting is the process of evaluating and selecting long-term investments to maximize shareholder wealth. It involves carefully evaluating and selecting long-term investments, always aiming for the maximization of shareholder wealth. We categorize investments into types like expansion, replacement, research and development, and strategic projects. These include expansion, replacement, research and development, and various strategic projects, each with unique considerations. Several crucial factors influence these investment decisions, guiding whether a project is undertaken or not. These factors include future cash flows, the inherent project risk, and the crucial cost of capital. Now, let's explore the various capital budgeting techniques, which are essential tools for evaluating investment projects. These are the practical tools and methods we use to rigorously evaluate potential investment projects and make informed choices. Net present value, or NPV, measures profitability by discounting all future cash flows back to the present. You should accept a project if its net present value is positive, indicating it adds value to the firm. The internal rate of return, or IRR, is the discount rate where a project's net present value equals 0. Accept projects where the internal rate of return exceeds your company's cost of capital, making them viable. The payback period calculates the time it takes for an investment to generate enough cash to recover its initial cost. This method favors projects with quicker returns, as it focuses on how fast you recover your initial investment. The Profitability Index, or PI, is the ratio of the present value of future cash inflows to the initial investment. You should accept a project if its profitability index is greater than 1, indicating a positive return. Modified Internal Rate of Return, or MIR, addresses IRR's shortcomings by assuming reinvestment at the cost of capital. It improves upon traditional IRR by assuming cash flows are reinvested at a more realistic cost of capital. Let's now summarize our key learnings from this session, reinforcing the essential concepts we've covered. Here are the key takeaways, crucial points to remember that will help you in your financial decision-making journey. Remember, game theory offers a robust framework for making strategic decisions in highly competitive business environments. Nash equilibrium helps anticipate outcomes when all players act optimally and independently, a powerful predictive tool. Effective pricing strategies must always align with your costs, perceived market value, and the competitive landscape. Capital budgeting is vital for evaluating long-term investments, ultimately aiming to maximize shareholder wealth. Techniques like net present value and internal rate of return are crucial for assessing project profitability and risk. Making informed financial decisions is absolutely vital for sustained business growth and a competitive advantage.